All right. We're back. We're back. We've got a couple of great guests backstage here, kind of getting ready to go, and excited to jump into a conversation about stablecoins, which I think continues to I was talking about before, but there's been kind of rise and fall in the media. But I'm interested to hear about kind of the undercurrent, people who have been working on it more, linearly over the course of the last few years or even decade in some of these kind of players' positions. But anyways, if you've been here before, thanks for joining. If you're new, also thanks for joining. We're excited to jump into it. I've got a little bit of I've got some time to kill here as we let people stream in. Everyone's always a little bit late, especially on the 4th of July week. But without further ado, I'll start to introduce these guys and we'll get ready to go. So, you know us, hopefully already, but if you don't, we do a lot of these events. You can check out our Luma, at that lu.ma at sandhillmarkets.com. We do a newsletter that markets this stuff on a regular basis and kind of talks about the general venture ecosystem and kind of early tech scene. And then we have a big syndicate where we share a variety of early stage and late stage stuff, some crypto, some AI, some kind of all over the place. But much more importantly, our guests today, who I appreciate jumping on, and I'll let them give more thorough intros as I typically do. But we got Farooq's co-founder at Rain, crypto native corporate cards. I'm excited to hear about kind of how that actually plays out. But before that, he is a second-time founder, and again he'll correct me where I'm wrong here. And before that was at Treasurer and Investment Officer at North American Development Bank. I feel like a lot of the I was when I was LinkedIn stalking these guys beforehand. I sense a theme in the stablecoin crowd. A lot of guys coming out of former bankers, former financial system people who see the opportunity and jumped into it. So that's Farooq, and I'll let him go a little bit deeper. And then we've got Bhanu, from CEO at Layer 2. Layer 2 is an infrastructure player in the stablecoins and digital asset space. I'll let him kind of explain more deeply what that means. And before that, he was, I don't know how to describe Capto, largest digital practice, which I interpreted as consulting in the finance space. So I had a note of calling him a banker, but I don't think calling him a banker is maybe the right way to say it. I'll let him elaborate further. But so with that, and I think we're coming up on time, and I'll get through this pretty quick. Excited again. Thanks to Sacra for helping us put it together, and I'll get these guys up here at the 5-minute mark to get into it. Hey,
Adam.
I was especially light with the intros, as you can tell. But so as to not misspeak, but I really appreciate you guys jumping on, and I think that the stablecoin and kind of fintech infrastructure conversation continues to be super relevant and exciting. I mentioned the rise and fall of how much everyone's paying attention to stablecoins, right? Which is it's not a new thing. It's something that's been around for a long time, but it continues to be this recurring theme of like a huge part of the crypto ecosystem and what's super exciting about it. So really happy to get educated by you two, and thanks again for joining. To start getting into it, and I talked to you both a little bit about Run of Show, but to give everyone context, we'll have Bhanu and Farooq introduce themselves, introduce what they've been building and how they got into it. Ultimately, a little bit of basics on the stablecoin ecosystem, some definition of terms, maybe some key players as you all see it, and then we can get into some of the more interesting stuff, which is the history, where we were, where we've been, where we are. Talk about some of the regulatory stuff, some of the adoption cycles, and then ultimately where you see those trends headed. So I think it'll be a nice a conversation, and I would expect a conversation that you guys have a lot. So nothing new from you all, from your side, but a lot of new stuff from our side. Farooq, do you want to lead us off? Give us a little intro on you and Rain.
Yeah, for sure. So I'm Farooq Malik. I'm the co-founder and CEO at Rain. We have been building digital money infrastructure since 2021. We started off building a lot of the settlement and underlying authorization stack for stablecoin payments, and then on top of that, we built our first product, which was a POC of a corporate card program. And yeah, now we are moving more into enabling others with stablecoin payments technology and the full kind of end-to-end flow from both custodial and non-custodial balances. My background is mostly is from traditional finance. I was previously in development banking as the chief investment officer and treasurer of a bank, and then prior to that, I was in structured finance in banking and private equity operations. So that's been my background, and that's what we're doing. But yeah, excited to chat.
Quick, we just had someone from Lithic on. I'm forgetting his name. He was head of development at when I think about corporate cards, is that like a apt kind of comparison? But on a crypto infrastructure side, where Lithic is on the more traditional finance side.
Yeah, so we started off with like a product that we launched on top of our issuing stack that looks a lot like Brex or Ramp. And
Okay.
a good kind of analogy for Rain is we're kind of a Brex plus a Lithic plus the bank plus the
Got it.
Okay. So we decided that in order to build a digital money solution, we needed to be vertically integrated on top of all the digital money pieces, and that's why we probably built a little bit more than we would have if we were trying to go into a banking as a service or card issuing as a service play. Really with a thesis around owning as much of the stack around digital money and authorizations and payments as we can.
Got it. Yeah, I'm interested to dive into like that. I had a great conversation I think 2 weeks ago about the stack, the fintech stack, and I'm excited to when the more traditional fintech stack, and now talking about how the crypto kind of the new stack kind of builds in. Bhanu, I'd love to get a similar kind of intro for you in Layer 2.
Oh yeah, thanks, Adam. So prior to starting Layer 2, I was a partner at Capco, a global financial services firm. Worked with almost all the banks in North America, all the top ones. So yeah, my background is TradFi. Prior to that, I was in healthcare. My startup in healthcare got acquired by a defense contractor, so I spent some time in defense. Yeah, my experience at Capco, which got acquired by Wipro, really did shape what we're doing at Layer 2. More specifically, building new products on top of old infrastructure is still old products. And I call it lipstick on pig. No matter how much lipstick you put, it's still the same. And when my co-founder and I, both of us left Capco at about the same time, with a vision and a mission to kind of transform financial services infrastructure from the ground up. We felt that digital assets represented the best opportunity and the best sort of alternative to traditional financial services infrastructure. Everything from what we call the core of the bank, where the ledger of the bank, all the way up to products that a bank sells, whether it be checking products, savings products, mortgage products, payment products, whatever. And so we actually started the company by building a crypto as a service platform. Very similar sort of thesis for what you had, which was the infrastructure in crypto is so raw that we can't just go and launch a BaaS product and go plug into a bank, right? We have to essentially build that infrastructure so other fintechs can build on top of it. And we are infrastructure people, myself, Farooq, kind of the whole company are infrastructure people. We're not front-facing fintech. Though we don't build the sexy stuff that Brex and others build, and Rain to some degree. We do the plumbing. We're the plumbing people, and we're very happy being the plumbing people. But so that was going really well. We were cross product and a lot of interest from banks, and this is pre-FTX, and then there's pre-FTX and there's post-FTX. Post-FTX, within a couple of months, everything dried up, pipeline dried, revenue went to zero. It was a really difficult time. We had a choice: do we pivot? Do we shut down? I think everyone goes through that at some moment in their company. We were seeing a lot of demand on the payment side. More specifically, we were sort of starting to see and this was, I would call it early 2023, mid 2023. We were starting to see a glimmer of hope when it came to stablecoin driven payments, but not from the US, not from Canada, globally, outside of North America, really. But we were also seeing that companies didn't want to just do stablecoin payments. They actually wanted an infrastructure that created a hybrid of both, so they can on and off ramp make third-party payments, receive third-party payments, and kind of make those large-scale corporate payments. With what was driving it is everybody hates Swift, right? And because they hate Swift, any alternative that can help them move money faster was attractive to them, and stablecoins obviously being very payment centric, asset class, actually was a perfect fit for those types of use cases. And so, yeah, we pivoted to create a payment infrastructure company, leveraging both fiat assets and digital assets to move money effectively across the globe. We are infrastructure, as I mentioned, so our infrastructure is used by other fintechs, other neobanks, banks in some cases now are also coming on board, payment processors, and so on and so forth. And yeah, happy to dive deeper into this and talk about some super interesting use cases.
Yeah, no, I'm excited to. I think it's a cool pairing, right? Because there's the pure infrastructure, strategy of Bhanu, and then the more verticalized strategy of Farooq. And I'm interested to hear about the decisions that got made there. Before we dive into some of the timeline that you mentioned, right, pre and post FTX, I think it'd be helpful to do some kind of key term definition, right? You talked about Swift. There's a lot of people, and I think alongside key terms, I think some kind of key players could be worth defining at a high level within the stablecoin space. So when you are, and I made the joke, if you're describing it to your aunt who's wondering why you work in crypto, why you left banking to work in crypto, or someone of that sort. When you think of like high level key terms in the stablecoin space, or we'll start with some terms that come to mind, and then we can move into players. Farooq, do you have? Swift got mentioned, but I feel like there's a as much as we can parse out the most important ones. I know it's a very long list. And we had that experience, even and I think the same thing goes in traditional finance as it does in the new crypto stuff. But any kind of pillars that I think we can hone in on to start.
Yeah, I think we can probably start off by defining the different types of digital money, kind of mechanisms. And so stablecoins is one of them. Stablecoins typically are issued by centralized issuers. They're backed or held against dollarized or fully backed deposits or cash equivalents. And then there's on top of that, there's tokenized deposits, which are a bit different. They can be issued by banks inside a closed ecosystem, or by even prepaid card companies. And then on top of that, there's algorithmic stablecoins, which instead of holding a deposit, they're backed by some other type of collateral, but there's an algorithm that is managing the open float to kind of keep a stable peg. And all of those different things kind of accumulate into this overall space. And there's lots of different people trying to explore and optimize various different pieces of this, right? And then on top of that, I think new entrants now is yield-bearing stables, which they look like a stable coin, but they have a yield component baked in. And that can typically be because they're holding the reserves in interest-bearing money market funds, or in individual QSIPs at the treasury level, or a variety of those two things, and they're sharing some of that float income back to the end user or the platform partner. So, it's important to kind of set the ground rules with all the different types of stable coins that are making up this broader market. We refer to it as digital money rather than stable coins, because I think that what we believe as a company is that the transition that's happening is not a transition between fiat money to stable coins. We think that this is a transition between electronic money, which is transacted on via fax or via electronic funds like SFTP messaging, and we're transitioning to a digital paradigm, into a mechanism to transact digitally, similar to how we switched from fax machines and modems directly to digital communications, right, by email and video. So that's what we think is happening as a company. And these types of representations of monetary value in this digital paradigm are indicative of the switch between electronic money or physical money and digital money.
Cool. Bhanu, yeah, you have some. There's still a lot. We won't break down all of that. That's a good enough.
Yeah, no. But there's, yeah, I think one thing I want to add to that as well is, you may hear me talk about CBDCs and what's coming, right? And I think there's a big open question as to, will CBDCs kill stable coins and so on and so forth, right? And CBDCs are central bank digital currencies. Think of them as the fiat equivalents of digital money. They are government backed, similar to how current money works. How they will function. There's various different models. There's a draconian model of everything is owned by the central bank to a more distributed model where each bank may get the ability to issue money like, some to match up with the fractional reserve banking that they do today, so on and so forth. So I think there's a whole kind of open question about central bank digital currencies and how or CBDCs and how they will interplay with stablecoins. But I think that future, if I were a betting man, is 5 years out at best, maybe sooner, but let's see. I think going a little bit backwards as to what are we replacing, at least at layer 2, is existing ways of moving money, right? When you talk about cross-border payments, and that's something that we focus on, is cross-border payments, is, there's two primary ways of moving money. One is you use, I call it SWIFT, right? And SWIFT was built in the 1970s. It's a messaging system. Money doesn't actually move. It's literally, few top banks around the world are on the SWIFT system. Anyone outside of them uses them or uses people who use them. And so you end up just message hopping. And sometimes it could be 4 or 5 messages before the money arrives at you. Banks in between sometimes sit on the money so they can generate overnights. So the SWIFT messaging system itself is great. It's the banking system and everything built on top of it, the entire infrastructure, the entire network that slows everything down. So that's SWIFT, right? That's what we are out to replace over the next 10 years, I would say. And I'll tell you why 10 years if you're curious. And then the other way of moving money that, folks like TransferWise and Revolut and a bunch of others have done a great job in when it comes to retail payments is holding treasury positions all over the world, right? It's like they don't actually move money every time, but hopefully they net settle in those big corridors they operate in. So, you may have someone like TransferWise hold money in the US and hold money in India. MoneyGram does that as well, and they hold money in Europe, they hold money everywhere. So if you as a individual want to make a remittance from US to India, as an example, money doesn't physically move all the time. It just maybe moves once a day, twice a day to net settle their positions across. And then when they move it, they do use SWIFT to move it. Again, each one of them has different challenges, and we can get into that. But, stables, and we'll actually, maybe I won't get into why stables are better than all of them. We'll talk about that in a second. But I just wanted to kind of level set on the old stuff that we're replacing. And, we also talk about stables and CBDCs in the future as well.
It's super interesting to hear you guys talk about the general, and from a consumer perspective, right? You don't think about this type of stuff. You just look at your, the number in your account, and you don't necessarily worry about, whether or not it's being held by, someone in your country or some other country, or the number is the number. And it's kind of this odd digitization of the system of actually having like physical money getting moved from country to country. So you can, in that little short history, I can feel the like it being built on top of like actual physical assets being built from country. Well, let's just like have some here, and then we'll change the number, but then you can send it later. We'll bring it across at a different time. The one thing, like in that conversation, and it's interesting to hear you talk about it as digital money rather than stables. And I think there's a good segue here into kind of the history. You mentioned pre and post FTX. Stables a broad term for a lot of different stuff, and stables as as a word, I think is interesting in that it doesn't necessarily, and we've had some scary situations where it's not necessarily as stable as you would want it to be. You mentioned a few of those, the collateralized internal system, internal systems, or algo. Are there kind of more prominent ones that you think of, or do they share that name? Like, do you think that a collateralized stable is more of a stable than like an algo stable, or is it? Do they all get lumped together and kind of share that term in a way that you think is fair, right? Like when I think about someone, and maybe some examples, and USDC being a collateralized stable, like the FTX former FTX name that I'm forgetting was an algo stable, right? Like, what are some key, like, I guess, brands in that breakdown of different types that people might recognize? I'll let either of you kind of jump in. I'm sure you both kind of know them off the top of your head.
Farooq, over to you.
Yeah, so I mean, there's the major stable coins, right, like Tether and Circle, which are backed ostensibly.
Ostensibly, yeah. See, that's the thing that gets that's they get or whatever.
And then,
Ostensibly,
and then I mean, there's like decentralized stable coins like Maker has DAI, which is more of an algorithmic or collateralized by a variety of different assets. And then there's tokenized deposits like JP Morgan has their own token on their own blockchain, et cetera. And so those are some of the larger stable coins. There's like FD, USD now. There's a Euro coin. There's a number of multi-currency stable coins as well. And there's a lot of emerging stable coin issuers that are launching additional tokens, right? Like PayPal with Paxos launched PYUSD, and then Paxos just recently launched their yield-bearing stable as well. So there's a variety of different types of stable coins in this ecosystem, and I think that that's probably going to continue. Like the supply of stable coins for a variety of use cases will probably continue. A good way that we I think about this, right, is stable coins will eventually become akin to gift cards, where it's going to be very easy to issue them in your closed loop. So if I'm Target, I can issue my Target dollar, which is now backed, it's held in a bank deposit. I can put that into a user's wallet on their phone or whatever it is. And then when they transact as Target, I can redeem that again against the balance, right? So there's probably going to be an explosion of a variety of different use cases where people want to generate yield revenue or float revenue for their own kind of deposit or balance program. And it's only going to become easier, right? With the MiCA framework in Europe, you can sign up as an EMI or PSP, payment service provider institution. You can issue your own stable coin, and they're creating the rules and frameworks for that. In the United States, at some point, maybe we will also get there. But I think the net result of this is going to be a proliferation of a variety of different types of stable coins and tokenized deposits, which will allow people to hold balances against a stored value instrument, right? Whether that's going to be a gift card or it's going to be a mobile wallet balance or whatever it is, or a product like a Cash App or a Venmo, that will probably become easier to build from scratch. Now, the challenge with that is going to be the same challenges that we have with gift cards broadly, is that you can't use a Target gift card at Walmart. You can't use a Walmart gift card at Delta Airlines. And that's where, we see a lot of opportunity at Rain.
Got it. Interesting. Yeah, Bhanu, thoughts on that?
Yeah, I mean, so it's interesting, right? So talking about different use cases for stables, definitely more fragmentation is great when you talk about rewards use cases. But when you talk about payments use cases, more fragmentation isn't exactly the best experience for the user, because kind of like what you said, you can't really take a Walmart gift card and use it at Target. But when we're talking about moving money cross borders, for us, it's very important that there's liquidity on both ends, right? They are market makers, and there are exchanges or market makers on either side buying and selling those things, and that can only happen with the largest stablecoins out there, right? So for us in the payments world, the reverse is important, that we have higher volumes in a few. It doesn't have to be one or two like Tether or Circle. It can be 4 or 5, and different corridors may have the different specialties. But as long as we can buy it and sell it, that's what's important for us. But I do agree that I think stablecoins, generally, that concept of stablecoins, let's just call it that for a second, will definitely improve the retail experience or the reward experience, amongst other other experiences as well.
And so we've touched on it a couple times, and I think that there are some interesting, specific moments. We talked about pre-post FTX. I'd be interested to hear other kind of examples of in the space that you think of maybe as pre or post moments, right? Kind of. But yeah, could you all walk me through, a high level history here? And I think that, it'll come out naturally, and I've mentioned it a couple of times, but there's been you mentioned that kind of the explosion of new stablecoins, but I'd be interested to hear a little bit anecdotally of the trend line you see as well. That might be a little bit outside of, how into crypto everyone might be at the moment, right? Everyone's into crypto again. Stablecoins are cool. Everyone's back at it. There was a time not so long ago where everyone was out on it. So I'd be interested to hear condensed history here of the last 10 years, which I think incorporate maybe pre you all. It sounds like for both of you, from a timeline perspective, if I'm remembering right, there was a time where you were on the traditional finance side, seeing stablecoins from the outside, ultimately made the decision to go and build in the space, and then the experience afterwards. So I'd be super interested to hear what you think are some of the key moments, both external, both for just like the general world of stablecoins and in your own personal experience as you've gotten into the space. Farooq, are there some key moments in your mind?
Yeah, I think like stable coins and their genesis from beginning to now has been pretty interesting if you kind of unpack it a little bit. Stable coins for the first however long, half a decade, 5-6 years of the early days of stable coins, with the current issuers like Tether and Circle, right? A lot of that activity was akin to kind of when you go to a carnival and you buy the tickets to like play the games, right? Where you would walk in the door, you'd give them your dollars, you'd get these tickets. And then it represented the economic value being created inside the carnival, right? So you would go in, you would acquire tokens with it, buy Bitcoin, whatever, go into a DeFi app, trade, speculate, buy a NFT, whatever it is that you were doing. And that was a value. I mean, essentially, it was a way to value the GDP of this ecosystem as the value that was aggregate locked inside this stablecoin ecosystem, which was a portion of the entire crypto ecosystem. I think that what we've seen over the last, several years, especially post FTX, is actually a decoupling of what's happening in the stablecoin space into two distinct things. One is the same thing, which is this like tokenization or the carnival tickets, as I like to call it. And it still represents some of the activity that takes place in this decentralized ecosystem, right? Where you're still transacting in DeFi protocols, you're still, adding liquidity or mining rewards, or transacting or sending money inside this closed loop. And then on the other side, it's what I like to call this, digital money ecosystem for dollars and dollar equivalents, where people are accessing stable coins as a proxy to access dollar liquidity and dollar savings or dollarized products. And what's happening there is completely different from what's happening in this crypto space. As far as what we've seen a lot of renewed appetite from businesses and consumers, which are really interested in being able to hold, transact in, and keep dollars in their own custody because their local governments are not allowing them to, make it very difficult to, or even because many of their banks in a lot of these smaller countries, they don't even have access to correspondent banking networks like what Bhanu was saying, where they can even access reliable liquidity into like a Kyrgyzstan or one of these other smaller countries where there's just not that many net inflows and there's limited access to any hard currency for the person to hold in US dollars or any other freely transactable international currency. So we've seen a lot of demand for dollars, and stablecoins end up being a proxy for dollars, which is why consumers and businesses alike globally are accessing them. In many ways, stablecoins are a way to buy a representation of the world's best product, which is just the US dollar, right?
I think Farooq, the key point is for now.
I think that's a separate conversation.
That's a whole different discussion.
That's a whole different thing.
Well, it's not going to be because of anything we did.
You guys are taking it.
No. Right. No, but in all seriousness, we are seeing some interesting demand for euros as well from customers for obvious reasons, right? Instead of transacting in US dollars, it's euros. So there's actually a whole market that's growing rapidly for Latin American companies to leverage stablecoins, but not USDC stablecoins, euro-backed stablecoins. So it's super interesting times.
Bhanu, when you think about that, so and for me to regurgitate a little bit, Farooq, and what you kind of laid out, where in the really early days, it was this on-ramp mechanism where it's like I go on to Coinbase, I'm gonna put dollars in, I'm gonna get USDC, I'm gonna hold the USDC there, and then the USDC is gonna move a lot faster when I want to buy Bitcoin or buy Ethereum because it lives in that crypto ecosystem kind of, and I'm sure there's like analogies to be made to some of the internal system kind of stable coins, like where it's in that ecosystem and therefore like transacts more easily there. And then you mentioned that, maybe that's 5 years ago. And then there was the growth of the digital money where you're actually facilitating, dollar like it's not about accessing the carnival. It's about transacting in dollars or, euros as the way you would normally do it. but then the mechanisms underneath the surface, rather than it being like these, more legacy like Swift systems, the pipes are built in this more crypto native technology, like this crypto technology, or whatever, these different stables that are allowing that to happen more efficiently. So you mentioned, is that something? Was there a catalyst to that before? And maybe Bhanu, maybe you can jump in if you think about it in the same way. Was there a catalyst to that change, or was it just was there a new product that, like, when did stables turn from carnival tickets to digital money? Was it something that happened gradually? Was there something in mind?
It is interesting, right? As I mentioned, we started to see this probably early last year to mid last year. It literally just flipped. Something flipped, and just the demand for that just went through the roof, where people wanted to now start using off-ramping stables, on-ramping into stables, and in some cases, want to leverage stables as a bridge currency to go from corridor A to corridor B. So, if we're operating in two corridors, they want to buy from us and sell from us in those two kind of endpoints. I do think there's a whole deflationary hedge concept, but I think what happened is there's a few things out. If I were to think about what happened during COVID, right, and why payments and why cross-border. So let's go back a little bit. And during COVID, the two big things happened. One is supply chains became very vulnerable. So a lot of companies decided that, hey, we need to diversify our supply chains, which basically meant that, money is now not just going to China, it's just going to Hong Kong, it's going to China, it's going to Singapore, Indonesia, India, it's going all over the place. And, how do you move money more effectively? People started to explore stablecoins and decided that, hey, that's a pretty interesting way to move money. Combine that with the deflationary aspect of to hedge against deflation. If you're a LatAm company, would you rather hold US dollars, which is very hard for you to hold because the banks don't actually offer US dollar products, or would you rather hold USDT actually on Tron and be able to deliver that to an off-ramp provider in the US, off-ramp it, and then make local payments or do international payments from the US? Clearly, the second option is more usable, but once it started to take off, it just kind of snowballed from there. The second thing that happened was people can work anywhere, right? Migrant flow, right? People are now just Layer 2's team itself. We are a COVID baby company, as I think Farooq, you are as well. And so our people are all over the place, right? I can tell you a lot of our folks that are not based in the US or in Canada, they all get paid in stables, right? Why? For the same reason why companies want to hold stables. It's because they would prefer that. They would prefer to hold stables and then protect against their own currency. So I think, Farooq mentioned something in our pre-meeting where he said, we actually didn't do anything. We just happened to be here doing the right thing at the right time, just capturing that demand. But really, I do think it's just demand that's grown with frustration from existing systems. I think COVID just accelerated the cross-border payment demand, that's what I would. That's our view of the world.
Interesting. Sorry, go ahead, Farooq.
Yeah, I was gonna just add one thing. I think part of it also is that during like the bear market in crypto, I think overall transaction volume declined in crypto, and yet like the transaction, speed at which transactions were taking place continued unabated, and people started uncovering that a little bit more. And so the tide going out actually helped a lot of people identify, oh wow, like there's actually activity taking place here, which is not tied to speculative action on Bitcoin or ETH or whatever it is. And so I think that helped people understand. I think the other thing that's happened that has helped with kind of creating the market catalyst for a lot of this stuff is the same thing that created the market opportunity for a lot of fintech products for consumers, right? Like those are fintech products where, traditional tech companies or just new tech companies came in and said, hey, this is an unmet need for parents or for, roommates or for people that are contractors, whatever it is. And they realized that there was just an unserved market segment with traditional financial services, right? And when you look at large consumer wins like Cash App, which has tens of millions of active users, that is a valid kind of replacement for a traditional banking product that a lot of people use it for, even though it's not a bank account, even though it's not a bank, right? And so this is just part of a much larger trend of people not having access to traditional financial instruments for a variety of reasons. and then finding the solution that is available that services the need that they have. And once you give them a user experience that they're happy with, and a user experience that they would come to expect from a more established financial services product, that person is quite happy continuing to use it that way.
Yeah, one thing I would add to this as well. I mean, remember the initial promise of crypto for Bitcoin as well was payments, right? Like it is the ultimate use case, and Bitcoin just never made it easy for various reasons. It's too slow to settle. You're not going to wait 15 minutes, 20 minutes for a transaction to settle. And now Bitcoin has kind of evolved in some ways beyond being a payment instrument, but now a store of value. So I think stablecoins plus the explosion of stablecoins across various chains, including the L2s, have made it much faster and much better alternative as a digital asset token compared to a Bitcoin.
It's interesting that you touch on. We had again the conversation. We had God, what was the name of it? It was like basically like fintech and payments conversation with Lithic and one of the partners from Matrix who covers fintech really specifically. And crypto often gets split out. It's like people talk about fintech and they talk about crypto. Like, oh, I'm a fintech investor. Oh, I'm a crypto investor. But really, ultimately, especially at the infrastructure layer, and when you talk about consumer products like Cash App or whatever, there are the decisions being made underneath the surface that are increasingly comparable between choosing a crypto infrastructure decision, like a crypto infrastructure decision, like these digital money, and more traditional systems that, if you're at the consumer level, you may or may not care, right? I think and that's been like the classic kind of value prop conversation. Right?
Like I've always found it kind of funny when people go into these camps. It's like, oh, I'm a fintech person or I'm a crypto person or whatever it is. For me, it kind of seems like if we were to look back on like mobile phones and landlines, if people were like, no, I'm not a telecoms investor, I'm actually a landline investor and I'm a mobile phone investor. Like looking back on it, you think about it as like it would have been kind of asinine to see it. I think right now the dots haven't been connected to the degree that I think a lot of people will eventually see. And then they'll realize that this is not like, these are not crypto companies versus fintech companies. We are money businesses. And the point is solving money problems for consumers and businesses globally. And that's the solution we offer to the market. It's not a crypto-based solution. It's not a stablecoin platform. It's just a financial services product an infrastructure that connects people from one problem to the solution, right? And like that's really what we're focusing on. And a lot of the use cases that we see, right, are use cases where much of the transaction volume is either going to be coming in from fiat rails into crypto rails, or it's going from digital money or crypto rails into fiat rails. And it looks a lot like how it looked when mobile phones came out. Like most phone calls made from a mobile phone went to landlines. And then eventually less and less did. And then eventually most phone calls placed in America or everywhere else in the world went to another mobile phone because it's a meaningfully better user experience. And it took a long time for people to realize that, oh, every phone is just a phone. And I think that here it's just going to be the same, right? People are going to realize at some point that digital money is just money. And I think regulation will do some of the work. I think just consumers will do some of the work. But I think that, in a lot of these international markets, people already treat USDC or USDT as money. Like I went to Turkey for a crypto conference last year. There was a kiosk where I traded in Tether for local Turkish currency instead of giving them my $100 bill, right? So that person is treating my Tether as money and I'm getting fiat cash on the other end. So like consumers are making the choices already. And I think eventually, like whether anybody agrees or disagrees or whatever is going to be moot because the users have already made up their mind.
Bhanu, does that ring true for you? Is that the experience you're having as well?
Yeah, I mean, pretty much. It's I 100% agree with this. It's something that is just going to naturally, the demand's going to grow, explosion of use cases are going to grow. I'm just kind of trying to draw parallels. I mean, I do agree with your analysis that it's going to go slow and then it's going to really accelerate, and by the time you know it, it's done, right? It's any new kind of innovation cycle. Which is why, back to my earlier point, it's going to take 10 years for fiat to go away. And when it goes away, it'll just be this amazing.
Maybe even longer.
maybe longer. I mean, we can place bets, and then we'll connect for 10 years from now when we're both old and figure out who won. But yeah, no, it is going to take a little bit, but I think in the meantime, definitely supporting that experience is going to be driven by the consumer. It's going to be driven by the corporates, right? I think the use case you gave about Turkey is a very, very fascinating one. We're sort of seeing we're hearing similar stories from various markets, right? Especially markets where it's very hard to hold US dollars, right? There's so much demand that yes, everyone will accept your USDC, USDT, and give you local currency in return, because they can then go and turn around and sell that for a lot higher to their customers as well. So no, it's going to be a really interesting time. Now again, what stable coins? How will that work with CBDCs? I think there's a whole kind of real world asset aspect of it as well that's coming in. It's like, do you really need a stable coin, or can you digitize a money market fund as an example, or create a token out of a money market fund and use that to transfer value? So I think there's so many fascinating sort of spin-offs from stable coins that are going to make this is a very fascinating time for the next 5 years for us.
One thing that I feel like I heard a little bit about in both of your kind of analysis of it, but it's the crypto versus fintech, and then this word adoption that gets thrown around all the time, and like the adoption cycle. And there's times where being in crypto is like great, because like, oh, you're in, like, oh, it's a crypto solution. It reminds me of like AI stuff right now. Like, oh, you're an AI company, like we want AI solutions. Like, oh, you're a crypto company, we want crypto solutions. And that has been this double-edged sword of where you get attached to these like hype cycles that have nothing to do with the underlying like efficacy of the technology. And I think that we saw, and I'd love to get your all's kind of thoughts on the rise and fall of the, I think what you see in the media around like an FTX, or, basically how people feel about crypto as correlated to the Bitcoin price having going up and down. But then I remember seeing headlines about the big corporates and their adoption cycle having nothing to do with the Bitcoin price. Like, I think that I saw the most like big bank adoption headlines when everyone was out on Bitcoin, rather than everyone, the conspiracy theory there's in the, it's like, oh, well, of course now they're going to get in like when it's down. Can you talk a little bit about that? The two sides of, where it can be helpful, like adoption wise, or if you always think it's negative, and what you've seen, I guess, in practice as a solutions provider on the adoptions graph that we mentioned beforehand. Like, it's hard to get that sort of data, but I think that you both touched on it, that it moves in interesting ways.
I'll answer the last question first, and then we'll get into sort of what are we seeing. So from my perspective, we're seeing double-digit growth month over month, right? Sometimes some months it's single-digit percentage, but other months it's 20% volume growth month over month. It's crazy. It's so adoption is going solid. I think the sort of hype cycle of crypto and the negativity of crypto, let's be honest, was our own doing, right? It was the market's doing. There was a lot of fraud. In some cases, it wasn't even like, it's good old corporate fraud, right? Things that exist in every other industry, but attached to that, just a number of negative things that happened last year. The bar is higher, right? The bar is higher for us that are now building in this space to do it, to show that they are real life use cases. There's real world applicability, things that are not fraudulent. And yes, it is difficult, right? It's difficult for us working with bank partners, difficult working with the regulators, and traditional financial institutions to show them that, hey, we're not out here to conduct fraud. We're not even speculative trading at this point. We are literally just trying to build a product by leveraging digital assets as part of our ecosystem, right? We're a payments company, and we think that digital assets are a great way to transmit value from point A to point B. That's what we're using it for. We're not doing it to do anything else, and we're doing it safely. But I think, one could get frustrated with sort of all the negativity that gets attached to it. But I look at it as, listen, the burden's on us. Any sort of new innovation, half your job is education, half your job is building, right? And so that's, to me, I just see it as part and parcel of the world. I think, the hype cycle for Bitcoin, it's going up, it's going down. Yeah, and my family says the same thing. Hey, it must be great. Bitcoin's going up. Your business must be doing well. I'm like, yes. I think the sentiment of crypto, if it goes up, rising tides, blah blah blah, right? I think it helps for sure. But even when Bitcoin was down, our business was still growing. But anyways, that's just sort of my perspective on it. I just think your point about do we call ourselves? We proudly call ourselves a hybrid digital asset and fiat company, and because I think if you're just doing fiat, it's kind of been there, done that. We don't want to just rebuild what's been built already.
Yeah.
Yeah. Farooq, over to you.
Echoing Bhanu, it's for us. It's really about just solving the problems, right? Like customers find us, they reach out to us, they ask us, hey, can you help us solve this thing? And we do it, right? Like that's really what it's about. What we found at the very least is that appetite from our clients has not been impacted by market prices overall. I think one of the interesting things that we've seen, right? Like we started off as like the corporate card, like people know us because we launched a corporate card, but we're enabling a lot of platforms to issue payment instruments against stablecoin balances globally. And we don't even announce that capability formally today. Like our website doesn't really cover it. But in spite of that, we have this massive pipeline that continues growing because people are like, hey, I need this problem solved. And we asked around and you guys can do it. Can we do this right now? Right. And so for us, it's been very humbling to see the demand and appetite continuing unabated for something that we don't formally advertise as one of our capabilities. And it's a testament to the fact that like this is a problem that is emerging. And a lot of the folks that we work with or are working with or in the process of closing, many of them are just traditional financial companies where if we were to tell you, you wouldn't even believe that they would be interested in stable coins as a mechanism of value exchange or storage, just because they don't think about it that way. They think about it as I have a global customer base. I have a platform where people make money and they need to access the money that they make. That's how they really think about the problem space. And we provide them a payment instrument that then can be used globally by the people that are making money on their platform, right? So that's the problem that we solve. I mean, from our perspective, we're using a brand new technology platform under the hood. We're using blockchain settlement, stable coins as a settlement layer, but ultimately we're just a software and payments company. We provide services and we provide them to consumers that come to us saying, I have problem X, Y, or Z, and I need a solution, right? I think what's interesting with price action though, is it definitely impacts attention overall. And I think attention and having price action as a separate piece that can kind of grab attention to a market, I think is overall good for the most part, because a lot of industries don't really have this like external indicator where bystanders or just the broader community or bank partners or other people that might be interested in these products will be able to see on, like going on, CNN.com and having like the price of Bitcoin is up or something like that. It helps us as builders in this space kind of get a force multiplier almost, because when prices are doing well, it does put more eyeballs on our business. And when prices are doing poorly, it really just lets us run a regular business like any other tech founder would. And so from my perspective, it's good to have. And even when it's bad, it's still not really that bad, right? It could be a lot worse. We could be working in an industry where it has no public eyeballs. There is no public interest. There are no massive kind of tailwinds that are blowing because of choices that other people are making, right? Like we both of us, we have a business because there's some central banker in some other country that has been running really bad monetary policy for a long time. And that's contributing to both of us having some success, right? I think that is an external factor that a lot of businesses don't really have.
Yeah, the wins are sometimes in our favor and sometimes not, but either way, no wins mean no movement, right? I think if we ever get to a spot where people don't care how money's moved, and I think honestly most people don't care. We know what Swift is, we know what ACH is, and we know what FedWire is. Normal people don't talk like that, right? Just my dad, he's he moves money from Canada to the US for business stuff and personal stuff, and for him, for him to just be able to move money quicker from Canada to the US and move it within 90 minutes without having to go to a bank for large business transactions. For him, that's magical, right?
Yeah.
He doesn't care about, holding money in a wallet, managing his private key, and doing transaction. He doesn't care, right? So for us, we just bury the digital asset transaction in between. He actually doesn't know what's bridging this. He's like, well, that's amazing. That's a good experience. And I use him as sort of my benchmark for how easy to make it for people, right?
Yeah, the decoupling, I think, is the decoupling from the carnival, as Farooq maybe mentioned it or dubbed it earlier, is super interesting. I think, and you both mentioned, or kind of continuing on this like double-edged sword of the larger crypto landscape and how it is as a part of this. There's been some big failures in the space, obviously, and there's also been some big like adoption headlines. What are some of the do those, and maybe this is a new point based on what we're talking about, does that really mean anything to you all? I guess that's what we just talked about, where it doesn't at the end of the day. Maybe if it's a little bit more like when JP Morgan issues something, great, like legitimizes you, but at the end of the day, it's the technology that's progressing underneath. And as the technology continues to progress, which has nothing to do with the price, there's nothing to do with whether or not Silvergate failed. As long as once you get to that almost like feature parity moment, that's where the real uptick happens. It's not like there's not massive adoption because JP Morgan said that like, oh, it's real now. There's adoption because the technology fits the problem. It feels like is the larger takeaway.
Yeah, I would echo that, right? I think it's natural for any fast-moving industry to have things go wrong for a variety of reasons at a variety of different types of companies. And this is true in every single industry, right? It's true in, like Airbnb, and like lots of, hosts have had problems and all sorts of things like that. There's issues with AI now. There's issues with fraud in lots of different types of businesses. Overall, you're always going to have bad actors that are taking advantage, or people that are moving a little bit too quickly without having the right expertise to actually build the solution properly. So that's going to be essentially the price that we pay as a society for innovation and having the ability and freedom to transact. I think overall, the tide is headed. I mean, we're as an industry, we're headed towards more regularization, more rules for the road, which is good. I think having regulators be thoughtful and coming in with thoughtful regulations and thoughtful rules after having seen the failures is going to be ultimately good. I think also that, for us, our thesis is really around the fact that at some point there's going to be broader formal participation by regulated participants, by banks and central banks, et cetera. And when they come in, they're going to want to figure out how do we leverage this people that have already been doing it for a while to actually build day one of a regulated marketplace, right? And so the way that we think about it is that by participating in the system today, by building a solution which is doing everything correctly, we can cement a place for ourselves into this T+1 of a rules-based framework, rule-based digital market that will eventually emerge.
Yeah, no, that makes a lot of sense. I think that in the last 5 minutes here, as we kind of, and you mentioned a little bit of like the future and the regulatory aspects that are coming along. You mentioned the explosion of different stables for a variety of different use cases, and the reward system came up. Are there some, when you think of themes of the next 5 years, what comes to mind in this let's call it the stable or the digital money ecosystem? And I think that maybe to split it into two camps. One being on the consumer side, right? Like as a consumer, what do you think are new experiences that, or what we think you'll see emerge in the market over the course of the next 5 years? And then as on the builder side, when you think about building your business over the course of the next 5 years, are there things that you're counting on, things that you're scared of, things that you're hopeful to see? Again, in this the 5 or even 10-year timeline of building in this industry.
Right.
Bhanu,
Yeah.
you wanna-
Yeah, I mean, so from my perspective, there's a bunch of things that we expect over the next 5 years. Let's just start with, more regulatory clarity would be amazing, because right now, lack of clarity is what is making it hard for traditional financial institutions to participate in some form or other, right? Whether it's participate as being partners to our company, providing a vital function to give us access to local rails, or whether it is to eventually, we hope, become customers of ours, leveraging our rails to do cross-border transactions like they use Swift today and other partners, other vendors today. But the issue is, we work with some amazing banks, and in discussions with a number of other amazing banks. The issue is not that the banks don't want to do it; it's just they just don't know how to act because of the regulators, right? And so that clarity, that is going to be so important for us to, and we're starting to see kind of bits and pieces of it come out in various different ways. So I think that clarity is going to be so important for deeper adoption, and more participants, more partners to join this ecosystem that we're all collectively building. It'll be great for everyone. If banks, some of the largest banks, say, hey, guys, if you're doing payments, we're going to treat digital asset payments like any other payments business. Yes, there's some nuances. We have to understand how you transaction monitor, blah, blah, blah. But at the end of the day, we want this to be harmonized. We want it to be, and we want the banks that participate in payments today, at least for our business, to participate in digital asset driven payments as well. Not to be a digital asset on and off ramp. We have other partners for that, of course. But I think just giving us access to the rails so we can conduct our business and grow our business would be a great start. I think that's one. So regulatory clarity for us. The other thing that we're pushing for, and pushing towards, is just more expansion into other large geographies, so we can do more what I call pure digital asset driven payments rather than leveraging Swift, leveraging FX partners, and so on. So just opening up operations and regulated operations around the world is what we, at least for us as a business, is going to be very important to fully realize this future of a digital asset driven cross-border payment company, right? Today, it's a hybrid, and the world we want to build, what we want to see is that over the next 10 years at least, that there should be no Swift transactions left. Everything should go over high-speed rails, bridged by digital asset currency. Ideally, everyone's holding digital assets as well, so there's no more fiat. But I think, at least if we can create a world where money between big jurisdictions or any jurisdiction moves over digital asset rails, that will be a step function change for consumers and corporates alike. Everything from cost, time, transparency, convenience will all improve if we can leverage digital asset rails. And you see, I'm not saying stablecoins, I'm not using CBDs, it's digital assets in general. I think that I would say whether it's consumers or corporates, obviously most of our business is corporate, but we are starting to see an increasing amount of remittance players as well join the ecosystem and join the network and become clients. But from our perspective, I don't think they're that. I don't think corporates may be slightly ahead, but I think they're it's staggered. So I think both sides will come along. But yeah, I also hope that more people hold digital assets. I think that is the future we're going towards, and we're starting to see that, right? Especially with some of the corporates. If we can offer yield-bearing stablecoins and just even bury it in the background, not even expose it as a product, and if you can say, hey, client, you don't actually have to pay for on and off ramping your stables to earn yield. You can just keep it there. There's a category of companies that are now starting to adopt that and say, hey, okay, that's great, Layer 2, I'll keep my funds with you so I can do more payments with you if you can also give me some yield in return. So I think just generally, I'm hoping that digital assets, as you can see, digital assets are becoming closer and closer to fiat assets in terms of utility, in terms of regulation, and that's what we're building for, and that's what we hope is the rest of the world is also adopting.
Yeah, I guess for me, I think the main item that is on my agenda for like what happens next is really just one word. It's interoperability. I think right now we live in this like very fragmented universe. I mean, across fiat and digital asset ecosystems, like there's different blockchains, there's different stablecoin issuers, there's different types of wallets and all sorts of other infrastructure. And then similarly, like even on the fiat side, even today, I can't send money from Venmo to Cash App, right? Or Zelle to my Venmo account or PayPal. So interoperability, I think, is probably something that is going to have to come at some point, more broadly, right? I think one of the biggest challenges we have from an innovation perspective right now is that we have these silos which have been created over the last 20 years or 30 years of pretty good consumer apps or pretty good B2B apps, but they're limited in being able to be used by people off platform, right? So if you use a accounting system to make payments to people, you sometimes have to go on board onto someone else's system to even pay them in the first place, right? So there's a lot of friction around payments broadly. And I think a lot of that is driven by the fact that that the dollars that you send from your account are limited in their capability because they're electronic, or even worse, sometimes they're just, on these like mainframe systems where they don't even really have any data capacity, right? So when you send somebody money using ACH or wire, a lot of times they don't know what it's for. If you're using intermediaries in the middle, it shows up as someone else's name in the bank account, right? And so a lot of times there's a lot of reconciliation challenges there. And I know this. I ran like a treasury team at a bank, and we had a lot of problems that we had human capital deployed against in order to solve on a daily basis, right? Because we didn't know a lot of times what the money that was coming in was for, or who had sent it, and what it was supposed to be mapped to. So this is a problem that we have today in 2024 that companies and enterprises with abundant resources deal with on a daily basis. And by creating interoperability, by enabling additional kind of data transmission on digital money rails, we can start solving a lot of these problems and start moving people forward rather than trying to solve like these individual ossifications and these like systems that exist today, right? I think that's what we're most excited about. And then on top of that, interoperability means being able to use the things that you hold to transact in the way that you want. Kind of like what Bhanu was saying, a lot of people use their product as a way to send money, like his dad, right, from Canada to buy something in the US. Similarly, a lot of our clients and a lot of our platform customers are hoping to enable like a custom stablecoin to be used just like cash would be, right? So you can actually tap that payment card or your phone on a payment terminal globally, and anywhere where the supported network already exists, that transaction is seamless. Like the customer has no idea it's stablecoin based. The card network really has no idea it's stablecoin based. The merchant has no idea it's stablecoin based. And you can transact how you're already used to transacting, so that on day one of getting a RAIN enabled payment card, it's just like day zero or day -1 of having a payment card. You didn't lose anything, and you've gained a lot more that you don't even know yet, right? And that's really how we have decided to enter the market, by just giving you day one interoperability with every payment terminal anywhere in the world. And you don't have to believe in digital money to transact, right? You can actually just slowly start realizing that you can do a lot more over the, actually very short term.
Yeah. No, awesome. I think, well, it's an exciting time just generally in the space. You both mentioned, right, where there's a certain amount of timing that comes into any sort of innovation like this. And it's exciting times for both of you to have been building for a while, as it feels like, things are turning a little bit, regulators starting to like put some guidelines out. And ultimately, this becoming less about, being a crypto company and more about just being a payments company. And that being like a real conversation, which it really, I feel like that makes a lot of sense now, and would have kind of gotten like, wasn't, that was a more inflammatory thing to say, 5 years ago or whatever, where now it's like, oh yeah, well, yeah, it's just, it's all fintech. It's just a matter of, solving the problems. Thank you. We ran over a little bit. I appreciate you both staying on. We'll cut this up. We'll get this out, for anyone who wasn't here live, but, thank you again. I definitely feel a bit smarter on all this, and excited to see where you guys take us in the years to come.
No, thank you for having me, and I'd certainly feel smarter. Thank you, Bhanu.
Farooq, thank you as well, and Adam, great job on hosting this.
Thanks, man. Thanks. All right, we'll talk soon. See ya.
Bye.